and welcome to Futures Investment Planet. Well, this is a YouTube channel which is going to deal with Forex trading, futures investing. So here I'm introducing you to futures investing. So what is a future? A future is a contract where a retailer or investor buys and sells an asset in speculation for a profit. So what does that mean? It means that we are going to either buy and the market moves up and you gain a profit, or we'll sell and the market moves down and you gain a profit. It is a legalized and standardized contract in form of an agreement to either buy or sell an underlying asset at a predetermined price at a specific time in the future. What that actually means is you buy some commodity or an asset, like let's say Apple, like Apple stocks. Then when you buy and the market moves up, you are gaining a profit. But if it goes the other direction, you are being cut out and you're making a loss. And there are various types of futures. Some of them may include stock futures, index futures, currency futures, commodity futures, interest rate futures, and VIX futures. As we go on, I'm going to keep showing you what each and every one of these ones means. Now, as you can see in stocks futures, they are widely known as stocks. What you hear people trading that are trading stocks of the kind of Apple, Facebook, Twitter, of that sort. So this is the type of future where parties involved must transact shares of a specific company at a predetermined future date and time, date and price. These kinds of futures are where investors and retailers buy shares, hold them for a long period of time in speculation of an increase in price, so as to gain profit in return. No, like as in the market crash in 1929, about that time when it had crashed, even of recent here in 2008, the market crashed. During those times, those are the best times pass to buy an asset and be cheap. And as you hold it for 1-2 years, you find that your asset or your portfolio is growing. So a portfolio is the liquid assets you have. So some of these features include Apple, Facebook, Microsoft, and many others. Now this is an Apple stock, as you can see here. As you can see, the gaps going up, that is the price movement. As you can see also, there is Tesla. But before we go there, you see now also Forex. Forex is a global over-the-counter market trade. Yeah. So in indices are contracts that allow traders to buy and sell a contract as derived from Forex index that can be settled at a future date. So indices are like Forex, but mainly these are a form of market movers. When you buy an index, you can for an index you can both buy and sell. So when you're doing with stocks, you can mainly sell, because when you buy a stock, you are to buy, and when you gain, you sell, and when the price goes in opposite your direction, you make a loss. So some of the indices that include the S&P 500, Dow Jones Industrial Average, and E-mini Nasdaq 100. So S&P 500, as you can see, all these charts may look alike, but they do different commodities and different futures. Now currency futures, these are what we these are currency these are where like the currency pairs. So these are exchange trade future contracts that specify the price in one currency at which the currency is bought, and the retailers and investors may hold the currency in speculation of an increase in that very currency, and when a desired price increase is reached, the currency is sold in return for profit increase. What does this mean? In currencies, you are going to have, let's say, the Euro USD, as we can see here. In this Euro USD, you are having the Europe the European Okay, in Euro USD you have the euro, and then you have the United States dollar. And then in the euro, you are, and if you are to buy, you are buying the euro in speculation for its increase. And when you sell, you have got a profit since the euro has gained a price increase in value. And you are selling you are selling a USD to get back your euro. Then as you can see here in GBP USD, you find the market moves up and down. What does this mean? The market comes to sell, bounces, goes up, comes back. It is up and down. The market is never constant. It is in a up and down format, which means it is in an impulse and correction move. Impulse, correction. Let me erase this and continue. So commodity futures, these are what commodity futures are. They are agreement contracts for buying or selling a predetermined amount of a commodity like coffee, cotton, and many others at a specific time or on a specific date in the future. These commodities are used to hedge or protect investment positions for speculation in the direction in which the commodity is going to move. So these are like buying a commodity like coffee online, but you are speculating that this commodity is the price is either going to increase or decrease. So when you are to buy, you're expecting a price increase, and when you are to sell, you're expecting a price decrease, meaning this you are going to sell and then get a profit when the commodity loses value, and when you are to buy and the commodity gains value, you will get a profit. Now you can see here in coffee, as I showed you the previous time, market is never constant. It's always up and down, as I told you, in impulse and correction. We shall get on to know this in further videos. So here, like as you can see, that is coffee. This is the liquid form of the price value of coffee. And then in VIX futures, these are contracts that can be directly speculated and are not affected by political, economic, and social events. Such can also be called synthetic indices. As you have been showing you these previous futures, I showed you the index futures, the stocks futures, the commodity futures. So those futures which I have shown you earlier on, let me get a bit back. Those futures I have shown you earlier on, they are affected by supply and demand, which is in our day-to-day life, and without that supply and demand, these markets wouldn't be moving. And they also affected by liquidity. Liquidity is the degree at which something has a high supply or demand, or a high demand. So if you find you are buying a commodity like the S&P 500 and you find the liquidity is so high and pushes the market up, meaning the amount of buyers in that market at that time were more than the number of sellers in the market during that time, then the other thing that affects these markets is our economic condition. What is happening in our day-to-day life? Are there wars? Are there elections? Such make the market move, more so commodity markets, because you find some currencies like the GBP USD is affected. Let me first get there. Let's say like this GBP USD, when you find that they're in elections, okay, let's say like they're in wars. When we're in wars, you find that this USD, the United States dollar, is mainly used as a security currency, and that's during the time, and during that time, that's the time when the the dollar increases because of these various wars that are affecting us. Now, as I hadn't yet shown you in volatility indices, which are VIX futures, they're also called synthetic indices. Now, synthetic indices are far different from all the others that I've shown you. Synthetic indices mainly deal with the market structure, these graphs on how they move. So the movement of these graphs, their areas and zones in how they move. For us, when we are trading, these are called markets. This graph we are watching is a market because this graph shows the human behavior and response in which it affect in which it responds to price. If you find it's moving down like this, people were in fear and they decided to sell their commodity. And then when you find it will reach this area and you find that the buyers saw opportunity and found that the price value at that time was cheap enough for them to find more value in it, and they decided to buy it. So it moved upwards, and then during this side area, the 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 sellers came into the market and saw there was a lot of supply in the market, and find that they were more interested in the market than the buyers. So the buyers became less in the market, and then more sellers were involved in that market, which changed the market move and changed in direction. So we shall keep on going with that, and we shall learn some different ways and some other things that are involved in market structure. So why are we going to trade? Who is trading in these futures? These futures are mainly moved by centralized banks. See now, like here in Uganda, we have the Bank of Uganda, which controls the different which controls what is transpiring in the economy. Now you find like in America, the United States, they have the Federal Bank. That's what they use, which holds the bonds that control the market movement, the economy, their interest rates, which involve and help in regulation of inflation and some other factors that affect it. So now the market movers are central banks. Those ones are central banks, centralized banks, those ones which are dealing with the country. The ones like the Federal Bank of the United States, the Bank of Japan in Japan, the Bank of Uganda here in Uganda, in the Republic of Uganda. And then there are commercial banks. Commercial banks, these ones are owned by private companies, owned by different people. Then there are hedge funds, insurance companies. Now forex brokers are the people that connect us to the market, the people who we use to, let's say, if I want to trade on these platforms and I want to go on a volatility index like this one, I will have to find a broker. This broker, I'll register with them, give my credentials. After giving my credentials, I'll deposit some money. I'll deposit, like, let's say $100, and these $100 is what I'm going to use to trade on these very, very markets here that you are watching. These very markets, and we'll have to know the market structure and how it affects these markets. And the forex brokers help us connect to the market, and that's how we start earning. Then investment banks, these are banks that only deal with investments. Then speculators are you and I. So us, the speculators, are the people who also trade futures. So why should we trade these futures? Well, the market for trading is always open. When the market for trading is open in a way that you can be trading from Monday to Sunday and there is no market close. But this only happens with different futures. When you are trading stocks, commodity commodity when you're trading stocks, commodities, mhm, index futures. Yeah, those three. When you're trading stocks, commodity futures, and index futures, those three deal with trading from Monday till Friday. But when you're trading VIX futures, the volatility indices, these ones I showed you last, these mainly deal with market structure only. They are not affected by economical factors. And when you're trading them, for them, they work from Monday to Monday. Whatever time you'd like to trade, the market is open. But the volatility depends on what time of, of, of at which the market is open. So these markets are highly liquid, and as I had told you earlier on, liquidity is the degree of which something is in high demand or high supply. Meaning, if this commodity you are trading in is in high demand, the market will move so fast that it will get a small retracement and continue moving. The other thing is that trading futures, you are having a high possibility of making profits very fast because of the high liquidity pool. A liquidity pool is like is the number of people who are involved in that market at that time, and which cause market movement. So now in these futures, there is low transactional cost, meaning you are going to spend less and make a lot. You are not going to spend really much, but you will make. But this also deals with how you understand the market. This market is really easily accessible for sure. That's the other point. Because in this market, you just need a phone and an internet connection. And as long as you have money on your account, you can trade and earn. So, meaning, even though you are in a restrictive area, you can still access the market as long as you have a good connection and a phone. Because if you come here and you're in an urban area, you can even be having a laptop, a tablet of the sort, which can give you more access and more visual representation of the market. The other advantage of this market is that the advantage of leverage, where a trader can enter a position which is much larger than the initial investment, which puts the trader in a position of making a lot of money. Here, what it means, the money you use to trade can be leveraged. Let's say, more like, if you have like 10, let's say $100, you can make a trade which can make you $1,000. Yes, it can make you $100,000 or more, $1,000 and more, depending on the discipline you have and how you enter the market. So this has been me of we have been dealing with the introduction to forex investing. So what we have talked about, as I can let me go get back and I show you. We've talked about the different types of futures: the stock futures, the index futures, the currency futures, the commodity futures, then the VIX futures. Interest rate futures are something I will need a much more detailed explanation to give. But in a brief understanding, interest rate futures are these kind of futures where you get you are getting commodities, two different commodities, and you are sort of like a middleman, and the transactional costs are for the broker. The interest the price you sell at which you sell the commodity, if it's higher, the profit you gain is what is yours. So you are like a middleman. So this is what I have shown to you. Thank you for being on Forex investment planet, and with this we have introduced you to futures investment. I've shown you what we have got involved with, and thank you for watching. And if you like this video, you can comment and we shall get back to you.